Ladies and gentlemen, the Federal Reserve has done it. They've lifted interest rates to now a 22-year high of 5.5%. And this is going to lead to much more pain for the banks, and it could be more imminent banking failures, because what caused the banking crisis in March 2023? Well, what caused it was the banks being most indebted, these bond prices being the most inflated they've ever been, and it also was caused by the Federal Reserve lifting interest rates at the fastest pace they've done in history. Well, now since the banking crisis in March, the Federal Reserve has lifted interest rates 2 more times, and what this causes is these bonds on the bank's balance sheet, for example, US Treasuries or mortgage-backed securities, or even worse, commercial mortgage-backed securities, is when interest rates go up for new bonds. If there's a new bond that comes out and it's paying 5%, and the bank still has a bond on their balance sheet that's only paying 2%, if you're an investor, why would you buy the bond paying 2%? You would only buy the bond paying 2% if you got a massive discount. So in today's video, we're going to go over exactly all the new changes that are going to happen with the new interest rates, what the Federal Reserve said about the economy, what the Federal Reserve says about the markets, what the charts say is going to happen, and also have a look at history to see what happened when the Federal Reserve did exactly what they're doing now. Because people, the real answer may shock you. So everyone, without further ado, let's get straight into the news, the facts, and the data. All right, look at this, everyone. Fed approves hike that takes interest rates to highest level in more than 22 years. So for those of you that don't know what the Fed funds rate is, it's just simply an interest rate banks charge each other for when they lend to each other overnight. But this leads into many kinds of consumer debt. For example, mortgages, credit cards, auto loans, and personal loans. So that's why even if you don't care or don't pay too much attention to the markets, you need to pay attention to what the Federal Reserve does with interest rates, because it will impact every aspect of your finances. So first things first, we need to talk about what's been happening before the new news. So the Fed has not been this aggressive with rate hikes since the early 1980s, when it was also battling extraordinarily high inflation and a sputtering economy. Now, there has been good news for the Federal Reserve. The CPI data has been coming in quite low, which is good for the Federal Reserve, but I think we all can agree that the real inflation rate is much higher. But nevertheless, news lately on inflation front has been encouraging. The consumer price index rose 3% on a 12-month basis in June, after running at a 9.1% rate a year ago. Consumers are also getting more optimistic about where prices are heading, with the latest University of Michigan sentiment pointing to an outlook for a 3.4% pace in the coming year. So what do you think, everyone? Do you think inflation is now down to 3%? Let me know down below. I think they made a typo here, CNBC, because I think that instead of saying CPI, they're meant to say core, because however, CPI is running at 4.8%. That's the rate when you exclude food and energy, because who needs food and energy to survive, right? That's not important. And, just exclude housing as well. We don't need food, housing, or energy. Moreover, the Cleveland Fed CPI tracker is indicating a 3.4% annual headline rate and a 4.9% core rate in July. So all those figures, while well below the worst levels of the current cycle, are running well above the Fed's 2% target. So this is not good for the Federal Reserve, and we'll get into their comments in a moment. Although economic growth has been surprisingly resilient despite the rate hikes. Now, something we have to talk about is the economic growth has not been quite resilient. It's simply only going up because of inflation. For example, if the economy grows at 2%, but inflation, or should I say the real inflation rate, is 7%, well, then that means we're having stagflation. Also, we're having record immigration, which is helping GDP go up. And we actually did have a recession. The economy did not hold up, but they just simply changed the definition. But nevertheless, according to their statistics, second quarter GDP growth is tracking at 2.4% annualized rate, according to Atlanta Fed. Many economists are still expecting a recession, though, over the next 12 months, but those predictions so far have proved at least premature, and GDP rose 2% in the first quarter, following a large upward revision to initial estimates. And what surprised everybody as well is the jobs market. Now, employment has also held up remarkably well. Non-farm payrolls have expanded up nearly 1.7 million in 2023, and the unemployment rate in June was a relatively benign 3.6%, the same level as a year ago. So despite the Federal Reserve lifting interest rates at the fastest pace in history, going from 0 to 5.5%, unemployment rate has not budged a bit. Now, a lot of you have been commenting, and I completely agree. The reason for this is because inflation is so high high, the cost of living is so bad, a lot of people are getting second or third jobs just to keep up with the cost of living. And for example, you could get an extra job but only work 1 hour a week, but to them, your class is employed. And also a lot of these jobs being created are in retail and hospitality and leisure, which are normally low paying jobs. So yes, we could have zero unemployment, but if everybody's only making 30K a year, well, they simply don't have enough to keep up with the rising cost of living. So okay, now we got the context. CPI is falling, the economy is apparently doing much better than expected, and the jobs market, so it's quite a mixed bag. So let's get into exactly what Federal Reserve said. But first, a quick word from today's video sponsor. Today, I've got something incredibly exciting to share with you. If you've been interested in investing but didn't have access to traditional opportunities, well, get ready to change that. Introducing Link2, a game changer for accredited investors like you and me. They provide access to invest in private companies and startups. Talk about a unique opportunity. And you know what the best part is? Link2's platform is super easy to navigate and user-friendly. So whether you're a seasoned investor or just starting out, you'll feel right at home. And get this, Link2 has an impressive array of companies to choose from. You've got tech startups, healthcare ventures, you name it, they've got something for everyone. Now, are you worried about making the right choice? Well, don't worry, because Link2's got you covered. Their team of experts carefully vet each company before they're added to the platform, giving you that extra peace of mind. Now, for people that normally only invest in public companies on the stock market, Link2 is like opening a new door for new opportunities. You can diversify your portfolio and potentially earn higher returns. It's a smart way to go. You can earn fantastic rewards by referring your family and friends to Link2's platform. Talk about a win-win. So everyone, I'm thrilled to be part of this amazing opportunity with Link2. Don't miss out on this amazing opportunity to make your money work smarter for you. Now to join, it's very, very easy. Just simply click the top link in the description below to get started with Link2 today. So markets were watching for signs that the hike would be the last before Fed officials would take a break to watch how the previous increases are impacting economic conditions. While policymakers indicated at the June meeting that the 2 rate rises are coming this year, markets have been pricing in a better than even chance that there won't be any more moves this year. So this is very interesting. At June, the Federal Reserve was signaling there's probably going to be 2 more rate hikes, but now the markets think this is the last one, there won't be any more. And I actually agree, unless we get an upward surprise in inflation or some kind of event that could trigger oil going up or something to make other commodities skyrocket. Now, a lot of people in the stock market are hoping the Federal Reserve is going to cut interest rates at the end of this year, but in a moment, I'll show you a chart on the market should be careful what they wish for. So during a news conference, Chairman Jerome Powell said inflation has moderated somewhat since the middle of last year, but hitting the Fed's 2% target has a long way to go. Still, he seemed to leave room to potentially hold rates steady at the Fed's next meeting in September. So the Federal Reserve is no longer doing something called forward guidance. That's where they tell you what they're going to do next. Right now, the Federal Reserve is unsure. We're in uncharted territory. The Federal Reserve has lifted interest rates at the fastest pace in history. Inflation is falling, but they're very, very worried if they start cutting interest rates, or even if they signal to the markets that they will start cutting interest rates soon, that could cause a market melt-up like I've been warning about. If all of a sudden the stock market absolutely skyrockets, people take their money out of the stock market or their gains they've had in the stock market and go out there and spend in the economy, and all of a sudden the banks start lending like crazy, that could cause inflation to reignite again. I would say it's certainly possible that we'd raise funds again at September meeting if the data warranted, said Powell. And I'll also say it's possible that we could choose to hold steady, and we're going to be making careful assessments, as I said, meeting by meeting. So put it simply, maybe, maybe not. Powell said the FOMC will be assessing the totality of incoming data as well as the implications for economic activity and inflation. Markets initially bounced following the meeting but ended mixed, and they sure did react. Look at this chart here, everyone. This is absolutely crazy. The S&P 500 went from 4,556 all the way to 4,579, and then went straight back down again and then bounced up. So this press conference did cause a lot of volatility because the markets were thinking the Federal Reserve would come out. Yes, everybody expected they'll lift interest rates, but they're saying that they're hoping that the Federal Reserve will come out and say, look, this is the last one. No more rate hikes coming. We're actually going to start cutting. The markets did not get that, and the Federal Reserve was actually more hawkish than everybody expected by saying they still could lift interest rates, and that got the markets quite spooked. Now, for those of you that don't know what hawkish means, that just means the Federal Reserve still is open to being more aggressive with rate hikes and tightening monetary policy or tightening financial conditions. Dovish is when the Federal Reserve or a central bank is saying they're going to start cutting interest rates or creating more loose financial conditions. The post-meeting statement, though, offered only a vague reference to what will guide the FOMC future moves. The only other change for note in the statement was an upgrade of economic growth to moderate from modest at the June meeting, despite expectations for at least a mild recession ahead. The statement again described inflation as elevated and job gains as robust. But something else the markets didn't like is quantitative tightening. That's when the Federal Reserve sells assets on their balance sheet. But I'll show you after I read this that the Federal Reserve is actually lying. They're doing QT on their balance sheet, but then there's another facility where they're sneakily buying behind the scenes. So along with the rate hike, the committee indicated it will continue to cut bond holdings on its balance sheet, which peaked at $9 trillion before the Fed began its quantitative tightening efforts. The balance sheet is now at $8.32 trillion, as the Fed has allowed up to $95 billion in a month in maturing bonds proceeds to roll off. So we can see with this chart here, the Federal Reserve's balance sheet peaked around $8.9 trillion. It did bounce during the banking crisis when they were not meant to. That's what saved the banks here. Otherwise, it would have been much worse. But it has been falling every single month from 8.7 trillion down to 8.2 trillion. But like I said, this latest rate hike is going to lead to more pain for the banks. And let me prove to you with the charts that the Federal Reserve is still bailing out the banks at record pace in the shadows while they're selling assets on their balance sheet here. They've created this new facility, and this is what they do during every crisis. Just create some new facility, give it a different name, and keep the money printing going. So look at this, everyone. Emergency bank bailout facility usage remains at record highs as Fed QT accelerates. So I'll bring up this chart here. The green line, this is money market funds. We can see here their deposit inflows are increasing, and we can see the red line here, that is the commercial bank liabilities deposits, that is falling still. But this is the chart of the Federal Reserve Bank Term Funding Program. This is where the banks go ahead and sell these assets or lend them to the Federal Reserve. The Federal Reserve will give them a loan against these assets that have lost huge amounts in value, and that's hit a record of $103 billion. So everyone, unlike the Federal Reserve and unlike all the banks are saying, the banks are not fine. They're still under severe stress, just like what we saw with PacWest being taken over yesterday. Everything is not okay. Now let's talk about the stock market. Now, a lot of people in the stock market are hoping that the Federal Reserve will going to be cutting at the end of this year or early next year. Now, I think it's very likely that they will start cutting next year. And yes, that should be bullish for the stock market, but it's not always. Let's have a look at this chart to show that when the Federal Reserve cuts, it can lead to a massive stock market crash if they are cutting because of a financial crisis or a huge recession. So we can see here on this chart, the great financial crisis of 2007, the Fed pivoted in 2007 August, and then the S&P 500 crashed 50.1%, and it didn't bottom until 18 months after, as well as the dot-com crash. The Fed pivoted in 2000, and the S&P didn't bottom until September 2002, 21 months later, and the market crashed 38%. And you can see the list goes on, with the average decline being 28%. Because what you have to know is the economy and the stock market are two separate things. The economy could be doing great, the stock market could be doing poorly, or the economy, like what we saw during COVID, absolutely collapsed, but then the stock market did great because of interest rates being at zero and all the money being printed. So everyone, what I think we're in an unprecedented point in history. Debt is so high, interest rates are being lifted at the fastest pace in history, so it is still so uncertain. The Federal Reserve is not being clear whether they're going to do more rate hikes. I think they should do at least one more to really make sure inflation is falling. But I do expect their official CPI or CPI numbers will continue to fall, especially when they can just manipulate it. But real inflation will stay much higher than their 2% mandate. And what we have to remember is the lag effect. So we may not feel the full pain of these rate hikes until 6 to 12 months later. But everyone, what I think is more likely than not, as of now, until we get more data, that the Federal Reserve will cut interest rates early next year. They will start printing money again. This will cause a market melt up, and we'll see assets absolutely skyrocket. When they do this, the US dollar will tank. That's why I'm buying gold, silver, and Bitcoin as a hedge against the US dollar falling and real inflation staying elevated. And I am buying some AI stocks as well as a hedge, just in case it takes my job. But everyone, I don't think it will happen anytime soon, but I have been using the technology and it is accelerating at an alarming rate. So everyone, again, check out today's video sponsor link to, click the link in the description and sign up today. So everyone, what do you think about all of this? Let me know your thoughts below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.